Good morning, everyone, and welcome to today's program, Preventing Financial Fraud. This event is brought to you by the Pacific Northwest Defense Coalition, Banner Bank, and Aldrich Group. First of all, I want to make sure that everybody can hear us okay and see the screen. If you can, just type yes in the question tab to make sure that everything is working correctly. That would be great. Perfect. Thank you so much. Please feel free to use this same question tab at any time during the presentation. We will read these questions to our presenters today, so just type any questions you have in at any time, and we'll address these at the end of the presentation. Also under the GoToWebinar tab is a handouts option. Under that, you will find a copy of today's presentation, as well as a list of upcoming PNDC events. We are delighted to have two member speakers here joining us today. John Lauseng, CPA, is audit partner with Aldrich Group, formerly AKT, and Lee Hicks, VP and Treasury Management Consultant with Banner Bank. We appreciate both of them joining us here today on this important and timely topic. Fraud is on the rise, and there are some simple steps that both John and Lee will share with us today that can help our businesses not be victim of this fraud. So I will turn things over to our speakers here. First, we will have John Lauseng up. Let me get to his slide deck here, and John will join us in presenting on avoiding financial fraud.
Thank you, Kate, and thank you to everyone who's dialed into the webinar or who will have the opportunity to listen to the recording. As Kate mentioned, I'm an audit partner with Aldrich, and unfortunately, from our perspective, sometimes when we get brought in, it's after a fraud has already occurred. And it's striking because it's at a point when management or ownership has been defrauded and they're just unraveling what's happened. And the striking part of it is how easy it is after the fact to understand how it could have been prevented. And when I say easy, there are cost-effective ways to prevent financial fraud. So I've become very interested in the topic, and I've been very interested in helping businesses take the steps they need to protect themselves. So on the next slide, it's a bit of an outline of where we're going, and we're really here to discuss what fraud is, how it occurs, and how you can prevent it in your organizations. So who is fraud? On the next slide, who do you think of when I mention the word fraud? Most people think of highly publicized fraud such as Enron and Kenneth Lay or WorldCom or Bernie Madoff and his Ponzi scheme. Or others that are glamorized by movies such as Catch Me If You Can and Frank Abagnale Jr. But frauds occur far more often and by individuals that you may not necessarily expect, by your controller, by your clerk, or by your volunteer. Who else is most at risk of perpetrating fraud? It's not necessarily who you expect. The studies say, and I'll cite the studies later, but the studies say time and time again that it's a long-time trusted employee. And this is not just what studies say, but it's what we observe time and time again. Owners or managers often give a lot of responsibility to one person. Either they know everything about the business and they're trusted with that, or they know everything about their function in the business. This is exactly who perpetrates fraud, and owners are dumbfounded when they find out because oftentimes they've trusted these people like family. Other interesting statistics are they tend to be, oh, I'm sorry, Kate, if we can stay on that. They tend to be middle-aged, have an income of less than $100,000. They're college graduates, and they most often work in accounting, in executive management, or in operations. Why would these people do it? One of my colleagues once said that everyone's capable of it, it's just how far you'll push them. I tend to think that's a bit of a cynical view, but there are drivers for why people commit fraud. Inability to pay debts. As we know, credit card debt is higher than it's ever been, and so it might be financial pressures. They may feel undervalued or underpaid from the organization's perspective. They may be disconnected or feel disconnected from the business and what the business is trying to accomplish. It could be vices. Several times we've identified fraudsters who, when everything came to light, had terrible gambling, drug, or other addiction problems. And so it may be vices, or more typical in modern America, it may just be a lifestyle that doesn't match their income, particularly if there's been a demotion, a reduction in pay, maybe lack of a bonus that someone had come to expect. So it can be a combination of all these factors. What red flags can you look for on the next slide in fraudsters? This is difficult because you don't want to necessarily profile your employees, or you certainly don't know everything that's happening in their lives, but certain indicators are folks who are just living beyond their means. If they're driving vehicles that they couldn't otherwise afford, taking lavish vacations, and oftentimes we see after the fact when we've identified somebody who's perpetrated fraud that, yeah, that really never made sense that someone in that role and is driving a car like that. Again, you don't know everything about their lives, so that can be difficult. Or you might have an employee who's just a schemer, someone who's got a wheeler-dealer attitude, and I think we've all come across people like this, someone who's perpetually trying to game the system. That's a red flag. Or someone who is a control freak. They don't want to give up anything to do with their function in the business because nobody else can do it as well as them. It won't get done right. Actually, that creates an environment where if you don't have cross-training and other people that understand what's happening within the function of a business, someone can perpetrate and conceal fraud a lot easier. What is fraud? On the next slide. Technically, it's an intentional deception made for personal gain or to damage another individual or entity. But really, it boils down to two pretty broad categories: stealing of cash or other assets that can be convertible to cash, otherwise known as misappropriation of assets, or fraudulent financial reporting, more commonly known as cooking the books, making the business look better than it should, either in terms of profitability, of revenue, of growth, of certain critical financial statement ratios. Those are the two broad areas of fraud. Why does it matter to you as a business owner, operator, manager? Well, there's clearly the financial cost. Financial cost can be just what's stolen. It can also go beyond that into what you might have to spend on compliance or prosecution. But in certain circumstances, there's also a loss of reputation. Some of these can be more highly publicized, but even if they're not, it could also lead to a lack of stakeholder confidence, either from a governance board, from customers, from employees, depending on the nature of it. It could also result in a loss of certain proprietary data, such as very sensitive customer data, or maybe vendor lists that have been accumulated over a long period of time, or other intellectual property. In terms of hard dollars, on the next slide we'll see that the Association of Certified Fraud Examiners in their 2016 report to the nations on occupational fraud and abuse estimated that 5% of annual revenues are lost to fraud. That's staggering. Now keep in mind that that includes all the frauds that are captured, but those that aren't detected either. And of those frauds, they estimate that the median loss was about $150,000 and lasted for 18 months before it was detected. The interesting part of that stat is the median is actually skewed downward quite a bit because there are a lot of frauds that happen with pretty small dollars. So some of the frauds that have taken place can be much more significant. And the largest ones occurred in manufacturing. I happen to be a partner in our manufacturing and distribution practice, and so this one's particularly sensitive to me. The next slide. As I mentioned, it's really easy after the fact to look back and identify what could have been done to prevent fraud, internal controls that could have been put in place. But it's also difficult because as business owners or managers or operators, you're focused on running the business and generating profitable growth. And in many cases, you don't really want to be hamstrung by bureaucracy or additional process in a manner that might slow down your business. And I get that completely. But I'm here to say that there are ways to implement cost-effective controls that will not hinder your ability to do business, and that's why we're here today. Most of the victims of fraud have done that after the fact. As we saw on the last slide, lack of adequate internal controls is the most commonly cited factor when fraud occurs, and then if nearly 80% of companies modified after they were victimized by these frauds. You can go on to the fraud triangle. So the fraud triangle, this is something that as fraud experts and auditors, we talk in terms of a lot. There are three elements which, if they exist together, if they're present, it presents an increase in the risk of fraud. Opportunity, that's really the one thing that you can control. Are you giving an opportunity to your employees to perpetrate the fraud, either through lack of internal controls or lack of communication or lack of enforcement? It's how easily can I as an employee perpetrate fraud in the organization? Because the other two you have very little control over. Incentives and pressures, who doesn't have an incentive for more money or higher revenues or to see their department perform better? And a lot of people have pressures. As we mentioned, it could be because of medical bills, credit card debt, gambling, other things. There are constant pressures and incentives, particularly when you're talking about middle-class America working in some of these roles. And then rationalization. This is the fraudster saying, I'm not really doing anything that wrong. Or maybe they're saying, well, it's wrong, but I'm only doing it because I'm underpaid, I'm undervalued. There's an opportunity and this company doesn't really care about it. They've made themselves victims. It's all that kind of rationalization. But again, the point from this is these are the three elements to pay attention to. Opportunity is the one that you can exert the most influence over. The next couple of slides just go through the most common frauds. Misappropriation of assets, again, stealing. That's more common, generally less costly on a per instance basis than financial statement fraud, which if you think of Enron and some of those large ones, that's what was happening there. And then also corruption, including bribery, extortion, kickbacks, and conflict of interest with certain vendors. If you go on to the next slide, I'll just run through some of the most common that we've come across, that we've experienced, and that the studies say are the most common. So skimming, in its most basic form, would be in a retail environment, a retail employee taking the cash from a customer and putting it in their pocket rather than the till. Or you could have cash larceny, where an accounting group receives cash from a customer, records the cash, but then steals it before it gets to deposit. Billing and fictitious vendor are probably the most prevalent. They are the most prevalent, certainly the most prevalent that I've seen in my experience. And this is a situation where a fraudster would set up a fictitious vendor and create the paperwork to generate payments to that vendor. The tricky part about this is some of those vendors can look very similar to legitimate vendors that you have. And that's why the controls around vendor setup and review are so critical. Or check tampering, stealing check stock and making it out to yourself is the most basic form, or taking checks and altering them or forging them while they're in transit. Payroll is another one that we've seen, and this can take the form of adding a ghost employee that doesn't exist and paying that person, and that person's bank account goes to the fraudster's bank account, or it can be much more subtle. It can be increasing pay without the right authorization, decreasing certain deductions, changing their benefits. All those are ways that payroll can happen. And there are a number of others, but let's move on. This graph on the next slide shows how often frauds occur, what their frequency are, and how costly they are in each instance. Again, this is from the Association of Certified Fraud Examiners. And as you can see, billing frauds, setting up fake vendors and billing, not only are costly, but they're also the most prevalent. And then check tampering. So when your auditors tell you to make sure that you don't have signature stamps and that you keep your check stock locked up and document who takes it, that's why, because check tampering is costly. So what can you do about it? As employers, as managers, as business owners? We'll get to the detailed internal controls, the mechanisms through which you prevent and detect fraud, but many people don't think about the fact that a lot of these are more high level, they're more basic. Empowering your employees and protecting your employees. So one way to look at this is if you have an environment in which fraud can occur, you're actually doing a disservice to those employees because you're giving them the opportunity and putting them in a position where they have to make the decisions rather than setting up an environment where it's very highly unlikely that fraud can occur. But also, whistleblower programs have proven for years to be the single most effective way to detect fraud. And actually, their presence helps prevent fraud because employees need to know that they can communicate concerns about ethical behaviors or fraud without fear of retribution. And even though this seems like it could be costly, it's actually not very costly. There are plenty of services, some in this area, which will administer whistleblower programs for a very reasonable price. Another one is to develop a code and communicate the code of conduct. So I don't know of many clients that I serve that don't have a code of conduct. What's more difficult is that a lot of these codes of conduct are handed to an employee on their first day and they're stuck in a drawer not to be revisited. It's really important that management is communicating the importance of the code of conduct, how seriously it's taken, and that they expect employees to adhere by it. One of the ways they can do that is by training employees. So if you ask yourself, do your employees know what fraud is? Do they know that it could include expense reimbursements or office supplies? Do they know what fraud is? Do they know what it costs everyone in the organization and them? Do they know where to seek advice if they're faced with an ethical dilemma? Can they speak freely, or do they fear retribution? And do they understand that there's a zero tolerance policy and that if fraud is detected, that it's going to be dealt with swiftly? These are all questions to ask yourself when you're thinking about empowering your empowering your employees in the control environment. So on the next slide, culture in general, and we've hit on some of these, but the tone at the top. If the tone at the top is one of honesty and integrity, that'll filter through the organization. But oftentimes, companies will almost always say, yes, we've got an open door policy, one of total honesty and integrity. Usually it's built somewhere into a mission statement, it's on the wall. The real indicator of whether or not you do have that environment is by surveying your employees. So I would suggest an employee survey. There's a number of benefits to that, one of which is to identify whether your employees believe that they're operating within an honest environment, an ethical environment, and one of integrity. And the company should set realistic performance goals to that end. In terms of hiring practices, this is an area where obviously you want to talk to an employment attorney, but considering whether or not you should do background checks, performance checks, drug tests, but then stepping back and saying, okay, do we really have the appropriate skill set in our organization? And do we have the appropriate headcount? Do you have enough people in your accounting and finance department that you can have reasonable segregation of duties to improve that control environment? And then, are you dealing with poor performers? Even though this doesn't seem to be directly linked, it actually has quite a correlation. In an environment where people understand the expectations on their performance and poor performers are dealt with quickly, it bolsters the morale of the people working there. And then engagement of management. You should ask questions about the processes. You should ask questions about the financial statements. You should understand your employees' perspective. This is a huge fraud deterrent when employees know that managers are invested, involved, and interested. On the next slide, we've got some entity level controls. These are a little bit more mechanical in nature, but the first is a fraud risk assessment. Has someone come into your organization and identified, and it could be internal or it can be done by a third party, identified areas of exposure for fraud, and then given you practical recommendations on how to mitigate those vulnerabilities? If you get a financial statement audit done, which I know many of you do, they may identify areas for improvement, but keep in mind that they are not engaged to do a full to do a full fraud risk assessment. How do you respond if a fraud is found? And the question is, do you follow through with your zero tolerance policy? This could include immediate termination and or prosecution. And clearly this is somewhere where you need to consult with your attorney before you take action, but rapid response and significant response to fraud is really important in terms of a prevention environment. And are you aggressively looking for it? Are you testing? Are you communicating that it's critical? Board oversight is also important. It's important to have an engaged board of directors, audit committee, depending on the size of your organization. But even if not that, at least engagement by management and perhaps an advisory committee, asking critical questions about the fraud prevention and detection mechanisms in place. And then, are your controls properly designed and monitored and communicated? On the next slide, and I realize that I will need to wrap this up in the next few minutes, but internal controls are transactions authorized. They need to be authorized, or a transaction should require appropriate level of authorization, whether it's spending more money, recording journal entries, establishing new vendors or new employees. And then there needs to be segregation of duties, and you've got to have the right head count and the right skill set to do this, so that you have different people authorizing transactions, recording transactions, and maintaining the custody over the assets related to those transactions. Mandatory vacations is something that I talk to many of my clients about. There are a number of business benefits, cross-training, so that one person doesn't have institutional knowledge, but also making sure that not one person can maintain complete ownership over a process. Not only will this detect fraud, it'll also help to prevent it if someone knows that there will be somebody else going through their work. And then the management review of financial statements. If the financial statements don't make sense, you ought to ask questions about it. Ask probing questions and make sure that what you're seeing in the financials lines up with what you understand as operators of your business. And finally, on the last page, I've got a few more granular controls that I'll run through really briefly, making sure that you've got physical security over your physical assets, but also your intellectual property. Making sure that your financials are done in a timely manner, and as part of that, accounts are reconciled and reviewed by somebody other than the preparer. Looking at your payroll register every once in a while and making sure that all those employees on the payroll register, that they only show up there once, that they're real people that you can put a face to, and that what they're taking home is reasonable considering their position. And then looking at some highly judgmental areas in accounting and revenue recognition, and making sure that someone in the organization has a good understanding of those and can explain them to management. So in wrapping up my portion, I just want to reiterate that when I go into organizations that have been victim to this, I immediately think you could have taken one or two very basic steps, all of which would have been included in this presentation to prevent this. And so I hope that this is a resource for you. Certainly, if you have any questions, I would love to field those at the end of this. Thank you very much for your time today.
John, thank you so much. Great information. We will hold our questions till the end so both John and Lee Hicks can address those. I will now introduce Lee Hicks, VP, Treasurer Management Consultant with Banner Bank, and he will go a little bit more in depth on some of these prevention methods.
Hey, good morning, all. I really appreciate the invitation to speak here, so thank you so much. And John, that was great information. Learned a lot. So I'm going to focus, we're going to continue our conversation on fraud, of course, but we're going to change our focus a little bit, and we're going to focus on payments fraud. And we're going to start off by discussing some of the trends that we're seeing out there. Payments fraud is something that we bankers, it's near and dear to our heart, for the fact that it's something that's occurring on a much more frequent basis nowadays. And I'm seeing in the Oregon and Washington marketplace at least one incident of fraud, payment fraud, occurring in this small environment that we're in. So if you wouldn't mind, let's go on to the first slide. I'm going to be basing a lot of the statistics that I'm going to share with you today on the Association of Financial Professionals in their annual Payments Fraud and Control Survey. The AFP has been doing an amazing job of conducting these surveys over the past decade. And you can see here we have a trend line that we can see going back to 2006 and up to 2016. Understand that the AFP is surveying hundreds of businesses nationwide. And it's largely agnostic to the size of business. It could be a small business, it could be a large multinational corporation. It's also indifferent essentially to the industry types that are affected. So you can see it's a bit of a roller coaster ride. We see a dip down in 2013 to its lowest point, but then a 14% increase from that point on until 2016. So why don't we move on to the next slide? We'll see a drill down to the payment methods that are most often targeted. You can see a legend at the bottom of that graph, and that, of course, describes what those colors refer to. And the payment method that's at the top is checks and check fraud. So that's been consistent over the past decade. It will continue to reign as king over all forms of payment fraud for the fact that it's a highly vulnerable payment method. The next one, number 2 now, is wire fraud. You see that wasn't always the case. We went back to very low incidents of wire fraud back in 2011, and now it's up to its current height. So we're going to be focusing on these two most common forms of payment fraud. And let's take a look at the next slide, please. So we're going to focus first on check fraud. This is the king in terms of velocity, the volume of fraud, not necessarily the largest leader in loss. 75% of organizations in 2016 indicated that they experienced fraud, and it was check fraud that they experienced. That's 3 out of 4 businesses, and if you haven't been impacted by check fraud, likely you know somebody else, another peer in the industry who has. And why is that? It's the most common payment method in the United States. It's still comprising 51% of B2B payments. They're all done by check. That has been decreasing over the years, keep in mind, and it will continue to decrease. But it is so integrated into our system and to our economy that it's difficult to peel away. And so we in the banking industry have been predicting the demise of the check, and it's been a lot slower than we anticipated. Checks are highly vulnerable to fraud. So let's focus on the next slide then, and this is an analogy that I like to use in discussing fraud with my business customers. What could go wrong with a check? I mean, essentially, it is a billboard. It is providing visibility and peeking behind the curtain to any passerby who has control of one of your checks. It's revealing everything that is necessary to defraud you, from the bank that you bank with, the associated account number, even a check series that might be a legitimate series for somebody to create a counterfeit check, and also we have an authorized signature. I mean, this is an archaic form of payment that is fraught with risk. Next slide, please. So what chances do we have of reducing check fraud? There are actually some silver bullets out there. So the first one is Positive Pay, and many of you may already be implementing Positive Pay and using it, but others may not. So if you don't mind, I'll just describe what that is briefly here. Positive Pay allows a business to inform their bank of the checks that they've issued. In other words, you're pre-authorizing your checks before they're dispersed. One would log into online banking, and within online banking, there's a Positive Pay portal, and you'd upload an issue file. Now, that issue file contains data, excuse me, that includes all things pertinent to identifying the legitimacy of a check. That is the account number, check number, amount, and even payee name. If one can export from their AP software, get their check register, and then export that into Excel, and then convert that either to a CSV file or a space delimited file, those are then ready to upload into the Positive Pay module. And once that's done, the system is armed. And as you write your checks, those checks go off to your vendors, your employees, and they'll present them to their bank for deposit. Those financial institutions, in turn, send them off to your bank expecting payment. And as those checks come in, the bank will compare those checks against the issue file that you previously uploaded. Now, if there's an exception, that means it's a fraud candidate. So that is your cue to log into the system, review the suspect item or the exception item, and you can make a payment decision. Now, the essence of Positive Pay is if you haven't pre-authorized checks, then we're going to return the check unless you log in, review the item, and make a payment decision. Advance on, please. Now, the next alternative to Positive Pay, another silver bullet, is to eliminate the check. Eliminate it from your payment stream entirely. That's often easier said than done. But if we can eliminate the check, replace it with an electronic payment, an ACH payment, you are mitigating your risk. This too can be initiated through your bank's online banking portal. And when a beneficiary receives a payment that you've originated, all the things that are declared on a check and visible to everyone is concealed. Nobody's going to, they're going to see that you paid them, and they're going to know for how much you paid them. You may have included some additional invoice information relative to that payment, but they're not going to see the bank from which it originated. They're not going to see the account number that you're dispersing from, nor are they going to see a number, a check number, or anything along those lines, and certainly they're not going to know who authorized it. So some of the benefits with ACH origination would include payment date precision with a check. It's a bit of a Hail Mary, and you're at the mercy of the post office to deliver those checks in a timely manner. With ACH, you tell the bank, I want my vendor, I want my employee paid at some predetermined future date, and it happens on that date. And since there's no check, that cannot get lost in the mail, so no stop payments are no longer necessary. Once a beneficiary receives those funds too, unlike a check, that check can be held. An ACH funded payment is 100% collected. So that bank, the beneficiary bank, will not place a hold on those funds. And checks by far are more expensive to the ACH alternative. You certainly don't have to worry about check stock, printer, toner, envelopes, or postage, and so on. If you could advance on, please. Now, it might seem a little silly to mention this, pre-authorized ACH withdrawals, and some people don't necessarily like this option, but it is removing the check. And if we can remove the check, we're eliminating check fraud. When I say that not a lot of people like to give their vendors access to their accounts to come in and withdraw funds, we have to understand that the check presents a greater risk. And there are some controls that we can institute. You might want to consider utilizing what we call ACH Positive Pay. It is the cousin to check Positive Pay, but it protects against unauthorized ACH withdrawals. It will allow a business to greenlist pre-authorized trading partners. You're not authorizing individual transactions, yet you're authorizing a trusted party. Best examples are utilities, your bank, giving them access to come in and pull funds from your account. You would greenlist those. You could also institute a dollar threshold. So where somebody is pre-authorized, if they've tripped a limit that you've instituted, say $500, $50,000, whatever that is, if it goes over that limit, then you'll receive an alert that says you have an exception item to review. You would go in, examine the transaction, and then make a payment decision. Again, no payment decision is made. The bank is going to return it because it wasn't pre-authorized. Next slide, please. Let's switch gears and let's talk about wire fraud. That is the second most common form of payment fraud. 46% of businesses per the AFP survey have been exposed to wire fraud. And that is up from the 2009 incident of 5%, and that is by and large due to BEC, what we our acronym for Business Email Compromise. And the FBI has been tracking this for years, and from October 2013 to the end of last year, they've recorded over 40,000 incidents of domestic and international BEC incidents, exceeding $5 billion in losses. Those are staggering numbers that we have to get our minds around. Wires present a vulnerable form of payment that is typically associated with high dollars. It's instantaneous. As soon as a wire goes out the door, it's very difficult to retrieve those funds because they are sent as collected funds. As soon as it lands in a, let's say what we call a mule account, it's an account that was opened purely under the guise of being a legitimate account, but whomever is manning that account on the other end, the wire lands, they clean that account out immediately. So potential for immediate and high dollar fraud losses is pretty significant. Next slide, please. So what is BEC? I'll paraphrase the FBI's definition because they pretty well nail it. It's a sophisticated scam targeting businesses that regularly perform wire transfer payments. The scam is carried out by compromising legitimate business email accounts through social engineering or computer intrusion techniques to conduct unauthorized transfers of funds. The FBI has a unit called IC3, which is the Internet Crime Complaint Center, and they have been tracking reports. These are voluntary reports by businesses and banks from all over the nation as well as internationally. So not a single state is immune from this, and it's been perpetrated in well over 130 countries across the world. The rate of increase of these losses between over the past 2 years, from January 2015 to the end of 2016, the losses have been staggering. I mean, 2,370% increase. The average loss is about 110,000, although that is the average. Losses could be much, much higher. Where are these wires going? They're going to beneficiary bank accounts across the globe. Up to 79 different countries have been tracked. Most significantly, however, China, Hong Kong, and the UK are the primary culprits. Next slide, please. So here's some examples of bank or business email compromise. It's essentially a spoofed email to an employee. So if we look at the top incident or example, a spoofed email to an internal employee, allegedly from an executive internally, requiring that emergency wire transfer be sent. Bank controls have been put in place to thwart external attempts to cyber heisting. The fraudsters have realized that the weakest link is the human. We're easily manipulated. So if somebody can spoof an email that otherwise looks legitimate, it appears to be coming from an executive or another authority, and they request that a transfer be sent. In many cases, the person in the AP department doesn't want to question that. They want to honor the request in a timely manner. So that is a primary example of BEC. The next example down, is a bit more complex and requires a bit more time because there's multiple culprits involved in order to orchestrate and perpetrate the wire fraud. So these are coming again from an authority. They are suggesting that this is a confidential deal. Perhaps it's about an acquisition that's in process. And they may even refer then to add credibility to the conversation. They may suggest that you reach out to an attorney. Of course, it's another crook who's acting or posing as an attorney, and that attorney will disclose the beneficiary account information. So this type of these type of hacks or this type of email spoofing takes quite a bit of time, and it's typically involving malware that is downloaded to one's computer, probably communicated via email. You're clicking on an executable file or a hyperlink that then starts the download process, and these folks do their homework. They will track the organization by looking at your email, finding out who the players are, who has the control, who has the authority to initiate or authorize wires, who has the ability to initiate them, understanding the corporate speak and your business culture to then pose themselves as a legitimate authority within the company. The final example is they're spoofing a vendor email, and that vendor is simply saying, we've moved, please update our business address, or we've changed banks. Please update your beneficiary account information so that the next ACH or wire that you send will go to the correct account. Next slide, please. So wires are by far the most popular form of business email compromise induced payments fraud. You can see 60% of those that are reported are indeed wire fraud. There are other methods, checks being the next, and then of course we include ACH in commercial part as well. But wires are king, and we've talked about why that is. They're immediate. It does require that somebody be manipulated or encouraged to facilitate a wire via a spoofed email. Next, please. So how can we prevent BEC from occurring? The only way really is we should not be relying on technological defenses. We need to be focusing on our human resources. We need to be educating and training our employees. They need to be aware of what the risks are, how to identify an email, what to avoid, what to do thereafter. So information is indeed power in this case. Second, avoid the free web-based email accounts. I can't tell you how many of my customers are still sending emails from their Hotmail and Gmail and Yahoo accounts. And these are large business accounts with significant dollars to protect. So these are the email accounts that are easily exploited, easily replicated. So please, if you haven't done so already, ensure that you're using a company domain name email account and require that for all of your employees. Next, we'd want to ensure that we are very cautious about what we declare or put out on our company websites and through social media. Do not share specific job duties and descriptions. Avoid sharing hierarchical business structure details. I would recommend excluding any and all finance and accounting staff from your website. Let your employees know that if they've got a LinkedIn profile, be careful about what they're revealing in those profiles. Suffice it to say, we'd want to scrutinize all emails. And of course, we'd also want to ensure that if somebody's receiving an email request that's applying some type of pressure and indicating that there's a sense of urgency, we want to treat those as irregular and scrutinize them in great detail. And our last slide, I believe, we have, please do not allow an email to be the final form of authorization for an outgoing wire or ACH transfer. Verify via phone any emails that are making changes or requesting such transfers. Contact the associated or respective contact associated with that email. Contact them via a known phone number within your system. Don't rely on any contact information presented in that email. It is likely also spoofed and fraudulent. Know your vendors, understand their practices and routines, as well as your own internal practices. If you have a business contact that is suddenly sending a personal email, that should be a red flag. always, again, confirm any email with a follow-up phone call. Take advantage of bank best practices, services that we can offer to our customers, such as dual controls. Dual controls reinforces your internal control policies by mandating that it takes 2 people to initiate and then subsequently approve an ACH or wire payment. When you have one person holding the keys to the kingdom and their email is compromised and they're the ones who have the ability to initiate a transfer outside of the company without additional approvals, consider that to be operating at your own peril. Finally, if you do have a compromise or if you have some concern or fear that you've been presented with a compromised email, contact your bank immediately. Please contact the authorities. And also, as I referred to earlier, the IC3, they do track this, and would really encourage that you go into the website, the link I've provided here, and upload your report to ensure that these are statistically being tracked, but also so that the authorities can determine and identify new trends that are occurring in the marketplace. So I've shared a lot of information here. However, we're just scratching at the surface. So I do very much appreciate your time, and if you have any questions, please feel free to ask and be happy to answer them for you. Thank you.
Great. Thank you so much. Scary to hear all the fraud out there, but very simple solutions to help protect your businesses. We do have a few questions, and I'll invite John Lauseng back on the line as well, and you can both address these. First question, does issuing work credit cards to employees for business expenses help reduce or increase risk or fraud? Lee, did you want to address that first?
Sure. That's one of the benefits. It's a double-edged sword, if you will. So one of the benefits to using a commercial card is the Visa and MasterCard networks are reliably defending cardholders when it comes to fraud. And as long as it's reported in a timely manner so they can mitigate their loss, they, of course, they like to say that they can help prevent and even reimburse in instances of fraud. Cards are susceptible to fraud, but Visa and MasterCard need to ensure that that people readily accept and use credit cards. Otherwise, if there is some sense that there's jeopardy involved, people aren't going to use it, and there goes all their fee income. So Visa and MasterCard is offering a ton of payment protection. I would highly encourage the use of that tool, just as long as you, of course, have policies internal to how an employee should be using those cards, when and where they can be used. And if you're utilizing commercial cards, work with your bank to determine, is this a purchasing card or is it a travel and entertainment card? And the reason why that's important is they can restrict certain purchase points depending on the type of card and who's using the card. If it's a P card, a purchasing card, you wouldn't expect somebody to go out and buy airline tickets or go shopping at the store. You would expect them to be buying services, requisitioning supplies, and whatnot. And then with T&E, it's the opposite. You would expect them only to be using it to buy meals while they're on the road, hotel accommodations, and airfare, and so on. Then they can restrict all other payment categories. So the card holder is operating within the confines of their pre-designated abilities. I hope that helps to answer the question.
Wonderful. John, did you have anything to add?
The only thing that I will add that Lee didn't point out, I thought his answer was absolutely spot on. It also helps to reduce the risk of fraudulent expense reports, because if the employer has access, and in many cases will utilize a program to match the expenses to the receipts, there's less of a chance that an employee could submit a false reimbursement form. So I would say that's the only other thing that I would add from my perspective, and I agree with everything that Lee said.
Great, thank you. We do have another audience question here. Addressing for a smaller business with only one or a part-time person in accounting, how do you suggest they achieve those segregation of duties?
That's a great question. Okay, thank you, and thank you to whoever submitted it, because most of the businesses we work with are constrained by the number of people they can hire. And so on a spectrum from having no controls to perfect segregation of duties, the reality is always somewhere in the middle on that spectrum. If you've got one employee, the answer is that management or ownership needs to be tremendously involved in the review. So if you've only got one person in accounting, somebody needs to be reviewing their work, and if they're preparing bank reconciliations, for instance, it may be the owner or another manager that needs to be reviewing those. When you go through a fraud risk assessment and you have someone advising you on that, there are actually certain controls that you can put in place that are designed for a one-person accounting team or a three-person accounting team. Obviously, they become more robust with the more people you have, but there are ways to do it. And so my answer, again, would be that the manager or the owner who that accountant is reporting to needs to be very highly involved in the review of the work that they're doing and understand it. And number two, consult with your accountant, external accountant, if you don't have someone internally, to address the things that can be done in your environment.
Lee, did you have anything to add?
No, I think vetting the employee is super important, as John is saying. Background checks are absolutely essential. But aside from that, no, John's spot on.
Great. Thank you. Really appreciate all this information and some great steps that our members can take so they are not a victim of fraud. Again, we appreciate all the expertise you lend to the program and appreciate your support of PNDC. I encourage our members to contact Banner Bank or Aldrich Group for assistance on your financial or accounting needs. We appreciate your support. I will make a comment about some upcoming PNDC events as well. Our Supply Chain Opportunities Conference series. We'll have one in Bend coming up tomorrow, and then one June 27th at In Situ in Bingen, Washington. We'll also have our Military Employer Summit coming up, one at Camp Murray in Washington, and then one at Camp Withicum in Clackamas. Then we will also have our annual Homeland Security Symposium coming up June 8th, which several Department of Homeland Security acquisition leaders coming out to the Northwest from DC. So thank you everyone for joining us. John, Lee, we appreciate you being here, and thank you to our audience. The webinar has now ended.